Greetings. Today is Monday, December 1st, 2025. I'm going to show you a couple of things that we can be thankful for in the U.S. stock market, as well as a couple of data points that we need to be cautious about. First up is the S&P 500, because that is how everybody wants to take a look at the U.S. stock market, despite how flawed that logic is. On the screen, I've got a weekly candle chart, and in particular, I'm highlighting that last week, which is, of course, Thanksgiving week. Certainly we can be thankful for that because that candle looks pretty bullish. But if we rewind the videotape, if we take that week out now from the 1st of October through the week before Thanksgiving, you can see the S&P 500 is actually negative. RSP is the equal weight version of the S&P 500. That is also negative. And of course, the small cap index IWM, the Russell 2000, is negative almost 3% for the quarter before we have Thanksgiving week. So let's take a look at that Thanksgiving week in a slightly different light, and I want to highlight how low that volume is. This is really low volume, so any movement in the index or in a stock when it has such low volume has to be looked at with some degree of suspicion. So a good strong week, but doesn't have the volume to confirm that move. That is definitely something to be cautious about. Having said that, let's look at a couple of other good data points. Up first is IWV. This is the Russell 3000. It captures about 95% of the United States stock market. We do need to be careful because it is also cap weighted. Down here in the bottom pane, I've got the percent of these 3,000 stocks that are above their 200-day moving average. You can see we had a negative trend going here. That downtrend has been broken. Now, if we change the data, this time we're going to look at the advanced decline line. Advanced decline line is advancing stocks minus the declining stocks, and that's how you get this line. This downtrend has also been broken. In last month's video, I shared a chart from my friend David Lundgren over at Motor Capital Management. I'm going to put that slide back on the screen now. As a reminder, this top pane is the S&P 500 and the bottom pane is this value line geometric average. David and I have been talking about this, and he calls it the mother of all divergences. I have a hard time disagreeing with him, but let's take a look at an updated version of the value line geometric average that is now on the screen. First thing I need to remind you about is the value line geometric average is capturing about 90% of the U.S. stock market, but it is doing it in an equal weight fashion. And so it is a better measure of how the broader market is. If we just look at the S&P 500, the reality is about 40% of that index is moved by just 7 to 10 different stocks. So the vast majority of what's going on is hidden underneath the surface. That's why we like to look at the value line, or I frequently look at RSP, which is the equal weight version of the S&P 500. But in the value line geometric average, we can see a couple of things. This is what I refer to as overhead supply. So if we find ourselves right here, if we're standing right there at the current price for the value line and we look to the left, anything above our eye level, anything above the line, that represents overhead supply. Now, what frequently, not always, but what frequently happens is when the price rises back up to these overhead supply levels, what happens is that supply comes to market and it puts a little bit of pressure on it. And so sometimes what will happen is as we come up to this overhead supply, we'll get a little bit of a battle between those bulls and bears. What I'm trying to also highlight here is in the bottom pane, I've got the MACD, which is a technical indicator. I won't bore you with the details, but that technically just printed a buy signal. So it is good news, in my opinion, that we're getting a buy signal when we're at this supply level, because that might very well equate to a breakout, which would be very good. If we go back to the chart from last month, one of the things that I mentioned then, and we've been talking about for some time, is there is an argument that the average stock or the average company has not really been thriving. Yes, the S&P 500 has been doing good, and NVIDIA in particular has been doing fantastic, but the average company is not necessarily thriving. We've been kind of surviving. And I'm going to come back to that in just a minute. So in just a minute, I'm going to show you some seasonality charts. Seasonality tells us that December tends to be a pretty good month. However, seasonality charts also tell us that November historically is the best month in the stock market's year. However, that really was not true this past month. Matter of fact, we see some reversal patterns also showing up. So while we can be thankful for the week that we had for Thanksgiving, one of the things that we need to be cautious about is this reversal pattern. Now, what am I talking about in particular? On the screen, I've got a monthly chart for the S&P 500. And these are candle charts. And one of the reasons I like candles is we get to name the candles and the formations. And this is called a hammer. And when we see a hammer candle at the bottom of a trend, that tends to be where we say we're hammering in the bottom. So a hammer at the bottom of a downtrend is actually good news. Not true when you see a hammer at the top. A hammer at the top of a trend tends to be called a hanging man, and that is also a reversal candle. Remember, these are not predictive, they are just suggestive. So this is, again, something to be cautious about. Returning now to the seasonality charts that I promised, you can see that November is the best month in the S&P 500 since 1950. However, take a closer examination, that's right there, that dot right there, that represents November 2025. So this seasonality pattern certainly didn't work out for the month of November. When we look at December, December again is arguably the second best month, but the majority of that tends to be the second half of the month. And that's where the term Santa Claus or the Santa Claus rally comes from. It's because towards the end of the month of December, historically, the S&P and the broader market begins to rally. Before wrapping up this month's video, I want to touch on a couple of economic data points. The first data point that I want to talk a little bit about is the Fed funds rate and whether or not the Federal Reserve is going to lower interest rates again this month. There has been some concern that they might not, and the argument has been that they are too focused on inflation. Well, if we look at the data, inflation is really not that bad. The 10-year average for inflation right now, as measured by CPI, is 3.1, and the last print for inflation was 3.0. Now, has inflation come back down? Well, yes, it has. Have prices come back down? Well, the answer to that is, of course, no. Well, the reality is that's deflation, and you arguably really don't want widespread deflation. Getting some retreating of gas prices and things of that nature is always welcome, but if it's across the economy, that tends to be more problematic. So there is a strong argument that inflation is relatively under control when you look at the historical data. So maybe the Federal Reserve needs to stop focusing on the inflation battle because maybe they've actually won that, but maybe we need to spend more time thinking about jobs. On the screen right now, I have the job openings data from the Federal Reserve's economic database. Now, I've got this marked here where ChatGPT was released. And this is an example of correlation, not necessarily causation. I just marked the chart because I was curious, when did ChatGPT come out? But what I really want to highlight is this massive surge in job openings after COVID. And since then, it has kind of crashed. And we've been in this sideways channel for some time. Now, this data, the latest data point, was supposed to be released on November 4th. I'm going to be really curious to see where that lands when it is released, but this is definitely one of the concerns. And now that the Christmas shopping season is really in full swing, this is an encouraging data point because the latest credit card delinquency rate data point, that actually ticked back down. And as you can see on the screen, we're in a relatively low environment there, and I would argue that is good news. From my perspective, it appears that the average American consumer is in relatively healthy shape, and that is one of the reasons why I'm not overly concerned about a recession, because recessions historically start when people are not really prepared for them. So this is one data point that suggests maybe we are prepared. So our final data point for today is going to be on the Fed funds rate. And as we can see, the Federal Reserve has started to lower that interest rate. that permeates throughout the economy. That's called easing. They're making it a little easier for businesses to get loans to expand their payrolls, et cetera, et cetera. Now, one of the things I mentioned earlier, I said I'd come back to it. Here we are, is we have been discussing this value line geometric average and how there is actually an argument that many companies have been struggling. They've been surviving, not necessarily thriving. Well, if the Federal Reserve continues to ease, if they lower interest rates again, that is going to make it easier for the average company to begin to thrive. Hopefully you found that helpful. If you did, please make sure that you've hit that like button and subscribe. If you have any specific questions, by all means, feel free to send me a DM. Be happy to see if I can't be of some service. You're also welcome to connect with me on LinkedIn. I do post there a little bit more frequently than I have time to make these videos. So feel free to connect and engage with me there if we are not already. And then finally, I would be remiss if I didn't once again mention my book. So far, I am very encouraged by the reviews that I am getting. Again, thanks for watching.